Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your daily technical analysis of foreign exchange markets.
Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these, my charts. This was all my own original work, as I think you deserve to have that. So with that, Euro-dollar. An indecisive doji cross on Friday after the previous session's bearish harami. Prices closed for a second session right on the flatlining mauve medium moving average, currently 116.42. Below we have the green short medium moving average, currently at 116.15. Then the November 2020 low, 116.02, which acted as a congestion the week before last, followed by the 2019 high at 115.70, which to me seems a dubious support. And then the key supports are the bright red lower bull channel line, currently at 115.27. The shallow July to date bull channel, with below this the January and February 2022 highs at 114.82 and 114.95 respectively, and then the rising gold long moving average, currently 114.75. Overhead we have the October 21 high at 116.92, which capped the market on a closing basis back in mid-October, and then not much until we reached the June 2025 high at 118.29, which is the gateway to resistance that stretches up to the 118.65 area. The action since late October still looks like a potential double bottom, or if we look from early October, into a potential reverse head and shoulders pattern. It is too early on both of these to be sure, but they are exhibiting the signs for such patterns, enough that I will lay out potentials, not targets yet, but potentials for the double bottom idea of a primary potential in the 117.77 area and a secondary harder to reach potential up in the 118.42 area. For the reverse head and shoulders pattern, that would have a primary potential up in the 117.88 area and a secondary harder to reach potential up in this at the same level as the double bottom one. There continues to be one other feature which I need to bring to your attention. Is something that I've now said repeatedly since about March this year. We are set up for a possible annual key reversal pattern here. Thus, if we close on Wednesday, the 31st of December 2025, either over 110.36 or under 103.53, then we'd be on. Anything in between would have a lesser outside year pattern. As we are now well into December, it's time to look carefully at this potential. It's a very long-term pattern, and right now looks like we are set up to achieve an annual key reversal up. So far today, a small dip down lower before a move higher, though not going much, if anything, past last Friday's high at this time before pulling back. Cable, aka sterling against the US dollar. An indecisive spinning top on Friday after the previous session's immediate countering bearish harami. Prices once again seem to be trying to stabilize over the important congestion between 132.81 to 133.30, and that's made up, and this is just a few of its constituents. It's made up from a pair of head and shoulders neckline extensions, currently at 132.80 and 133.22, and that's of the May to July head and shoulders top and the August to October head and shoulders top respectively. Then the green short medium moving average, currently 132.73, just edged out below that congestion, and the important gold long moving average, currently at 133.35, which just edged out now just above the congestion. Now, I said last week that this congestion could stretch possibly as far as the mauve medium moving average overhead, which is at 133.62, and I still stand by that, as it was this mauve medium moving average that halted moves higher last week, especially on Friday, when it capped prices. Beyond this, well, we don't have that much until a wider congestion band stretching from either the September 24 high at 134.36 or the September 2020 high at 134.83, all the way up to dark blue upper bear channel line, which is currently at 136.65, and that's of the July to date bear channel, and has been the showrunner of this market since midsummer. The direction this market seems to be taking led me a couple of days ago to look up to a build-up of a late October to date double bottom, and we have triggered this pattern. As I said last week, and I quote, "If this happens, then we have a primary target X2 in the 133.33 area, with a secondary harder to reach target X3 up in the 133.96. Well, and that's the end of the quote. Well, last week we reached the primary target X and we came within 11 ticks of reaching the secondary target, a harder to reach target X1. For now, I will still leave target X1 up there, although I will probably call it as being fulfilled, as I suspect we may have another effort to try up there. Finally, much like Eurodollar, there continues to be one other feature here which I need to bring to your attention. It's something that I've said repeatedly here since about March this year. We are set up for a possible annual key reversal pattern. Thus, if we close on Wednesday, the 31st of December 2025, either over 127.29 or under 125.11, then we'd be on. Anything in between would have a lesser outside year pattern. As we're now well into December, it's time to look carefully at its potential, very long-term pattern, and right now looks like we are set up to achieve an annual key reversal up. Now, so far today, a dip from the open down to the purple neckline and still below the gold long moving average, but a quick pickup over the gold long moving average, though not as far as the overhead mauve medium moving average. It's all very a narrow range at the moment. That's before coming back down to the purple neckline again. US dollar against the Japanese yen. A bullish engulfing pattern on Friday, if only just, that also could be seen as a possible hammer pattern, which is a typical bullish reversal pattern as well. However, the market continued its recent decline back down below the previously breached bright red upper bull channel line, which is currently at 155.70, and that's of the April to date breached but seemingly repaired bright red bull channel, which is currently 148.52 to 155.70. It was also moved back below the bright red upper trend lines extension to the October to mid-November ascending wedge pattern. This move lower had last week put on notice the retirement of the overhead target X at 157.90. This is the primary target of the move up and out of the October to mid-November bright red ascending wedge pattern. Further harder to reach target X1 is up at 159.65, which is also threatened with retirement. If something doesn't happen soon, then these two will be gone. Looking further below, we have the previously breached and broken dark blue upper time, currently at 153.53 of the July 24 to January 25 bearish shift picture. I'm not sure how useful this one would be, so I'm just adding that in there. So far today, an open low with a small move down, but we are seeing a recovery of sorts back up, as though the market seems hesitant ahead of that bright red upper bull channel line. US dollar against the CNH, the offshore Chinese yuan. A hanging man pattern on Friday, now traditionally seen as a bearish reversal pattern, though the data indicates it's more a bullish continuation pattern some 6 out of 10 times. This after the previous session's bullish white soldier and earlier low, the lowest low and low close since October last year. The market made a second consecutive close back up over, if only just, the important combined congestion between 706.32 to 706.57, and that's made up from the 50% Fibonacci line of the October 22 to April 25 move and the June 23 low respectively. The market's having a tough time trying to stabilize below this combined congestion. But if it does, well, there is little below until the 38.2% Fibonacci line of the late February 22 to April 25 move at 699.89. And that's right where we might find roundophobia from the big 70 number. Looking above, we have some mild recent congestion till about 708 even, and the lows of September, October, and November between 708.45 to 708.96. As I said last week, it all depends if prices can stabilize under 706.32 to 706.57. So far today, well, a slightly lower open and dip down to the base of the congestion band, but then a recovery to just over Friday's, well, round Friday's close. We're still within Friday's range. US dollar against the Brazilian real. A dramatic and strong bullish long white Mariposa on Friday that led to last week being a weekly key reversal up. Prices punched up through the green short medium moving average, currently at 536.20. The higher up July 24 low at 536.76, plus the August 24 low at 537.59, and a declining dark blue middle time currently at 536.63 of the mid-December 24 to mid-April 25 bearish shift pitch hawk, as well as the mauve medium moving average currently at 539.60, and even the pink neckline currently at 544.40 of the June to September 2024 head and shoulders continuation pattern, and the 50% Fibonacci line of the April to 22 to December 24 move at 544.57. But it failed to close over these last two. It seems the rally started to falter just ahead of the October highs seen in the 552.25 area, as well as short of testing the overhead declining gold long moving average, which is currently at 552.53. However, despite this somewhat dramatic move higher, the dark blue bearish shift pitch hook remains intact and continues to be the showrunner for this market. US dollar against the Mexican peso. A bearish opening black mirror bozo on Friday after the previous session's key reversal down. It was notable for being the lowest low and low close since July last year. Overall, the market continues to try lower out of the recent dark blue late September to early November shallow bull channel. This had a primary target in the 1832.82 zone, which has already been achieved, but there is still a secondary harder to reach target X down in the 1809.60 zone, which is not too far away. Nearby we have the lesser Fibonacci line at 1817.60, which ties in with the September low, but then really nothing until the combined August 2017 and July 24 lows at 1759.58, so caution. So far today, well, not much. Still either side of the Fibonacci line at 1817.60.
Thank you for listening. This short version broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.